Phil, the European bank sector looks to be in rude health with solid profitability, strong capital positions, and a low cost of risk. Your 2024 outlook points to quite a few risks on the horizon. What are those risks and what worries you most?
Yeah, thanks, Rod. I completely agree with that. Actually, if you look at the European banks, look at the capital ratio is 14.5%, 15% for most of the banks. Profitability at double-digit rates. So these are the highest we've seen for about a decade for the European banks. So you see, all things seem very rosy. The problem is, how sustainable are those, and particularly on the earnings side? And that's where we see the most risks. The revenue has been lifted massively by all this increase in interest rates. Problem is now, we're now at peak rates. Actually, they might start falling going forward. And at the same time, there's more and more pressure for the banks to pass on those rate hikes to savers. So actually, the revenue line is being squeezed for the banks. And at the same time, the cost of risk, say, has been very low. But with high rates and a weak economy next year, there's a good chance that's going to start rising. So they're the main risks on the earnings side of the banks.
Great, thanks, Phil. And if we think about investment banking businesses in specifically, this year's been marked with pretty low capital markets activity. With that backdrop in mind and the shadow of Credit Suisse still overhanging the industry, how are valuations being impacted?
Yeah, well, certainly if you look at the third quarter results, they were very weak for the European banks, down about more than a double-digit rate for a number of the lenders. And they also did much worse than what the US banks have done. So that's been a big concern. But if you look at the first half, and particularly on the fixed income side, actually the numbers held up very well for a number of the European banks. And if you look year to date, in terms of the overall fixed income business, actually the numbers have been upgraded overall this year. So things that yes, they've slowed down, but they're still on a longer term perspective, actually at quite robust levels. That said, say that big underperformance versus the US names, that is a concern for some. I think the Credit Suisse was seen as a special case. There's much more where these banks are going over the next few years. Will they continue to underperform versus versus the US banks? And that's a concern. And that's why a number of these banks are essentially what you'd almost call stress valuations of 0.4 times book value or 20% plus cost of equity.
And then the final question, Phil, buybacks and dividends, they're an important part of total shareholder returns and what investors look at. What do you think the risks are for both heading into next year?
I think, there are risks of both. On the dividend side, I think the risk is, we have peak earnings now, and therefore the earnings per share be hit. Therefore, the banks often pay their dividend based on a percentage of those earnings. So if the earnings are coming down, therefore the risk is the dividends per share are also going to come down by the same amount. But when you see those risks, you don't want to increase the proportion of earnings you pay out either, because you're looking more cautious, so you hold back. So therefore, there's definitely a hold back on terms of the dividend side. And then on the buyback side, again, the regulators will step in and say, well, actually, we don't want the banks giving all this money back to shareholders today. There's all these risks ahead. They might need this capital going forward. So therefore, both the buybacks and the dividends could be at risk.
Phil, appreciate your time. Thanks very much. We'll keep an eye on them into next year.